Hey, good morning, traders and investors, and welcome back to the Trading Analysis Wednesday live stream show. I'm your host, Bennett Tyndall. We hope you're doing well today, and thank you for taking time out of your busy Wednesday mornings to join us. Happy Wednesday. Goodness, September 14th already. We are approaching the holiday season. Can't believe it. It seems like it was just 2020, and we were all dealing with the coronavirus pandemic. So, again, hope you're doing well. As you can see, bottom left-hand corner of your screen, futures are mostly sideways following yesterday's volatility, with August Consumer Price Index report coming in hotter than expected, which is not quite what investors were hoping to see with the commodity trade coming off. So we'll get to the charts in just a few minutes. Before we get to the charts, we're going to bring in the trading analysis team, including Todd Gordon, company founder and director of investments for New Age Wealth Advisors. Good morning, gentlemen. How are you doing today?
Good morning, boys. How's it going?
Welcome. Doing
morning,
great.
everybody.
Hey, guys.
What's up, Alex, Terry, Todd? You guys having a good morning?
Another day in paradise.
Weather's cool, though.
That's right. That's right. All right. Speaking
Did
of,
you get some of that cool, fresh air coming down from the north?
Yeah, it's better than it was.
All that humidity out, man. It's been beautiful outside. Wife and I have been out taking care of the planters in the front yard, getting them ready for fall. And
nice.
Yeah. Did you get the Corvette over 100 yet?
Nope. Got to break it in first, boss.
Dude, that ECU, Todd, that ECU actually has a built-in restrictor or governor of sorts where it won't even let
There's a
him
regulator?
go. Yeah, he can't go above 4,500 RPM until it gets past like 500 miles or something. I don't know exactly the details, but it's pretty crazy.
You got to break the engine.
And then it opens up to 7,000, and then you get all the power of the beast. So yeah, we're going to take it for a run to Casino Cachada this weekend with the local Corvette club. So that's going to be fun.
Nice.
Terry got his dream Corvette, and I've been begging him to, once he gets into a 3-digit one handle on the speedometer, to get the phone out and get a nice little video.
Yeah, you got to blur that image out, Todd, because that's incriminating evidence they can use against you in a court of law. You recorded your own video.
But you were on a track, right? You were on a track.
Yeah, we get it out on a track. That'll be one thing for sure. Yeah, there's a place over here in Houston I've been looking at that motorsports.
It's beautiful.
Yeah, you can get out there and go through a professional driver's training, and they teach you things you never knew your car would do. So that'll be fun.
Everyone's watching. Click thumbs up and write in the comments if you think Terry should post a video on Twitter with 3 digits on the speedometer. Let's just see. Let's leave it. Let's do a democratic approach to it.
I love it. That's great. So hey, Chad. Good morning. Good morning. Yeah, I'm absolutely happy to cover small caps. Still the coolest intro music. I'm glad you're still liking it. I think it's time for some new content. We're going to be spicing things up here on the live stream, but glad you appreciate the production effort and quality.
That's another. We were talking pre-show. You guys notice small caps have been strong, growth and value. Like small caps have been strong. I have to think it's a dollar story. We could talk about it when we get in, but I thought that's interesting.
Yep. Yeah. It's been a challenging market. On one hand, yesterday, Todd, looking at the decline following the morning CPI data, obviously being short the market with clients, it was celebratory, but at the same time, at the end of the day, just looking across the board, there are still some question marks, which lead me to believe that, perhaps although we've invalidated the traditional impulsive uptrend, I'm not quite so sure this market's going to be just that easy. So we'll get to the charts. We'll get to the charts here in just a few minutes. Anything else that caught your attention yesterday with the way markets were trading?
Yeah, I have a lot.
Okay,
I won't
cool.
into it too much. From a macro point of view, there's some interesting developments. I think we got to put the CPI report in context and look at what actually happened, and then the result of Fed fund futures I find interesting. Futures I think I saw them up 7 or 8 tenths pre-market, and then down to flat. Now we're at 1/3. So yeah, there's a lot of uncertainty right now, but I think there's a few key things under the hood that we should look at. But you jump in. I got I'll turn it back over to you. I'll make my case in a little bit.
Sounds good. And Terry, just a heads up, we are getting some feedback from your end. I'm not quite sure why. We typically don't, so no worries. We'll get that squared up. All right, so I'm going to take you guys through the indexes. We'll take a look at the S&P 500. I want to present what I think is happening, and then I also want to present the alternate view, as it remains an important possibility as we're juggling the 2022 decline and whether or not we can secure the June low as the end of the correction. So, gentlemen, I'll be back on the other side, and we'll take it from there. See you in just a couple. All right, so let's hit it again. We're going to go hard right edge of the MotiveWave platform, the trading analysis edition of the MotiveWave platform, and we will first look at price action in the S&P 500, and we will start it off by presenting what has been my preferred interpretation of the indexes going back to, I would say, August 26th. Coming out of, first of all, pause. Let's start all the way back at the January highs. Looking at the nature of the sell-off in the S&P 500, it is not a typical trend-establishing mode of development. We've been through this multiple times. It is really best counted from a rules and guidelines perspective as a corrective trend, meaning it's just a series of Elliott wave corrections, which are grouped together, which is known as a complex correction. And being in a bit of a complex environment, I feel it makes sense to finally see the first complex correction print in the major market indexes. So the way I look at this is as follows. Going back to January, a clear three-wave move down into February, three waves back into March. When we were rallying into March, we had acknowledged the alternate. And the alternate simply said we were up in 1, down in 2, up in 3. And we knew that if this was going to be a wave 4 pullback into April, that it needed to maintain support above 44.16 spot 7.8. That level represented invalidation of the traditional motive impulsive trend, which is the most common way in which market indexes reverse from corrective downtrends. So that level was breached. 44.16 was breached. The minute we break south of that, we see a bit of a pause. Markets hesitate. We get a correction, and then we see the continuation to the downside. So that's really where markets confirmed continuation lower. We retraced into kind of late April and then proceeded lower. Okay, so where that brings us now is going back to the June lows. And from the June lows, we got a sizable rally up throughout the summer. It was a near 2-month-long rally that could have, in fact, been the end of the correction. And it may, in fact, still prove to be that the June low in the indexes represents the end of the correction. We're going to show you this in just a minute. But from the traditional motive impulsive perspective, the uptrend invalidated, meaning the same level, the 44.16 trigger point that we had in April was, in this case, 39.45. And you'll notice that off of the August 16th area high in the index, we get a move down that breaks invalidation of the traditional impulsive wave. As we break south of that invalidation level, you'll notice the market pauses. We had initially moved lower before Jackson Hole. Jerome Powell came out with a very short hawkish speech, and that continuation move set in. September 1st, September 6th comes along. We're holding support off a very short-term uptrend line support from the 16th of June through the July lows. And then we get the rally up into the August CPI report. I'm looking at this as the exact same setup as we had back in April, meaning I do believe that the indexes are preparing to break south and make new lows on the year. It is worth acknowledging that looking across the macro landscape, I don't see support for an all-out bear market where we could call this a big wave 1 down, a big wave 2 up, such as some are tracking in the industry. So I think even if we do break lower and set new lows on the year, that it's going to be only an entry opportunity. So if this is the count, zooming in down to the 1-hour time frame, it looks as if we do have a completed initial 5-wave move down in the wave A position, 3 waves back in B. We did a big 5-wave move down yesterday. I am expecting a bit of a retracement. And then in the event we see acceleration south of the September 6th low, that is where I will feel more confident in the idea that indexes are on the way to new lows for the year. Now, At the same time, there are still signs and charts to support the idea that the June low marked the end of the correction, and that perhaps, given that we've been in a complex environment to get to the June lows, that maybe we're seeing a bit of an unusual pattern from the low to resume the higher degree uptrend. So this is what I think is happening. If we look at what consumer discretionary is suggesting, which is one key bull market and growth sector, the consumer discretionary sector would actually suggest that what's happening in the indexes is what you see here in front of you. And that would basically say that June marks the end of the correction, and instead of this being a traditional motive impulse wave, this is actually a motive diagonal wave. And diagonal waves not only allow for the overlap of the corrective trends, but it requires it. And so if we go down to a 1-hour chart looking at the S&P back to the June lows, we could suggest that this is simply an ABC of a wave 4 of an initial leading expanding variety diagonal. Now this wave count technically remains valid above 37.2156, and I continue to track it as a possibility. It's not my preferred interpretation, but there are charts out there and there are some macro considerations that would suggest this may in fact be the case. I'll be putting out an email. If you're not signed up for our mailing list, you can go to tradinganalysis.com to get signed up. I'll be putting out an email later today with charts of the S&P as well as the chart of the dollar index and crude oil. As those are two charts that kind of substantiate what we're seeing here. And then over to small caps, looking at the Russell 2000, the same leading expanding variety diagonal is valid here. I feel this index really illustrates quite well the idea that even if we do break lower, that this has just been a series of Elliott wave corrections. We've got a 3-wave move down. We've got a 3-wave retracement. We get another 3-wave move down that is exactly equal in magnitude compared to wave W, so the initial move off of its all-time high. And that equality projection was demonstrated in magnitude of correction and almost duration. Not only that, as you can see here, the overall trend was contained within parallel trend lines. So although my preferred says that the summer rally was ABC, we've done 5 down, we've done a B wave, and we are going to break lower, we need to acknowledge and realize that we aren't smarter than the market and have the context to offer clarity in the event the plan A doesn't go our way. So that's the index coverage from me. I continue to remain short, cautiously short, as I'll show you here in a minute. There are charts that still say that the lows are in, and one chart in particular, which has been gaining relative strength compared to the S&P, is the chart of Tesla, and I'm sure others are going to be talking about this, but just looking at the chart of Tesla here, going back to its low from May, we've got to move up in 1, down in 2, up in 3. We did an ABC flat. Talk about a textbook flat. The C wave was 127% of a retracement of B. The wave 4 in this instance came very close to invalidation of trend. So that impulsive invalidation level, it wasn't met in the case of Tesla. Tesla held, and we've seen what appears to just be a garden variety correction here in a wave 2 position. Now, if Tesla breaks south of 264.21, and I'm going to put this chart in the email as well, that's when we could alternatively say this is just an ABC move up, and we've got 1, 2 down, and we are going to see continuation to the downside. Now, last but not least, and I've taken far too much time, let's take a look at the chart of WTI crude oil, because last Tuesday I put out a chart of WTI crude oil saying that this was a key development on the horizon that we were bringing your attention to, and kind of noting the fact that we were entering a zone, technically speaking, that should be make or break territory in regards to saying whether this is a corrective trend from the March 130 handle high or if this is an impulsive trend. And I feel this discussion is important given the inflation outlook and possibilities. So looking at WTI crude oil, if we've truly been in an ABC correction since March, down in A, up in B, down in C, last week we made note of the fact that the pattern appeared to be coming to completion. And the level that we brought your attention to was this. First of all, we noted that every time WTI met equality to the initial March sell-off, so the magnitude of March 4th through March 15th, if you measure the magnitude of that project it from B, 100% relationship. Every time we met that price objective or target, we did see upside rallies, some of them to the tune of nearly 14%. But then each time we kept probing the lows. And so last week, what we were expecting to see was this blue B wave resistance, and we were anticipating one final shakeout that would have an overthrow beyond the green corrective trend channel, but we expected it, if it was a correction, to find support at the wave 1 through 3 trend line, which, as you can see here, zooming in on the trend, is exactly where WTI started a near 10% rally. And I do see this as 5 waves up. So I think this is an important discussion that we should all continue to monitor, and an important chart that we should continue to monitor. If we are going to see WTI reverse back to 130 or 150, obviously the implications would be significant in my opinion, but substantiating that from a fundamental perspective, we'll leave that to Terry and the rest of the team. I can only, from a technical perspective, identify what the hard right edge of the chart is telling me. And then finally, I got to look at the chart of the dollar index. Over to the dollar index, and Alex is going to take a look at this as well. Here in the case of the dollar index, we continue, first of all, pause button. This chart helps me to put equity markets into context and also put the dollar rally into context, acknowledging the fact that we should be in the final innings of an impulsive trend. Meaning going back to 2008, we can identify this as a 5-wave move that is very close to major overhead resistance that we do expect to result in a sideways to lower consolidation move. But looking at cycle degree wave 5 on the weekly and down to the daily, I still think this cycle degree wave 5 can continue higher. And if we do continue higher, we continue to hold support at the 50-day moving average. We have a move up in 1, which I'll take you down to the 195. Here we can see orange wave 4, 100%. We get up to resistance, pull back, get above resistance, pull back to the 50% retracement of the uptrend from August 11th, hold the 50-day moving average, and now we're trying to poke back above resistance. But what's one interesting takeaway from this chart, and perhaps some of you have already picked up on this? One interesting takeaway for me as a technician, as an Elliotician, is the fact that if this wave count is correct, I'm calling for a series of 2 new highs that is ultimately terminal, meaning wave 3, 4, 5 to the upside, the dollar rally is done. How does that correlate to potentially what we saw in equity markets? Well, looking at the S&P 500, if you'll recall, I'm simply looking for 3, 4, 5, or essentially that, 5 waves down in 5, so a series of new lows in equity markets that is ultimately viable in a long entry opportunity. And then if for some reason, if we break south of support again, we could consider this to be a completed 5-wave move, which adds to the complexities of the market this year. So that's it from me. Back over to the team. What do you guys think, gentlemen? Am I crazy?
You're definitely crazy.
Well, we already knew that.
We already knew that.
Yeah,
no,
that's not nice.
No, it's great work. It's there's a lot of uncertainty. You know, there's a lot of macro headwinds. I can't wait to hear what Alex has to say on the macro side. Crypto has been very interesting, kind of on and off as a leading indicator to growth stocks. Seeing a pretty good relationship with the dollar, as you just mentioned, and crypto, as well as the stock market. Macro is very much in play here as interest rates are moving around so much, as the Fed is constantly being repriced as to what they're going to do, and Fed expectations. Fixed income in here is driving the currency markets, which is the dollar. Dollar then in turn is driving the equity and the commodity market. So sometimes you get a market that's just all about equities, or a lot of times just equity and disregarding the macro. But all 4 major asset classes, and some would argue we have a 5th now with crypto, are very much at play. So it's important that you understand all those other markets if you're going to be an equity. Certainly an investor, a trader, and even an investor, it's important to understand those other markets. But the wave count, there's a few different possibilities in here. I mean, I'm going to propose one. I've shown you before, Bennett, and I'd like to get your feedback on that. But I don't know. I got a few thoughts. But guys, what do you think?
I'm interested to hear what you got to say, Todd. You and I were looking at that Tom Lee had published some memos for his FundStrat subscribers
Yep.
the other day.
Yep.
And he had some very compelling evidence that don't fear the bull market is coming. So
I agree.
Yeah.
I agree. Even if it comes from new lows, I agree.
Yeah, and I think that's all that Bennett's saying is even if I think the major move that trading analysis, and new age my wealth management business, I think the big move we're trying to guard against or be prepared for is 3,400, and at that point, I think. I think then we're going to see even further capitulation. Sentiment will grow even worse, and then we will have found longer term support in the Nasdaq via the 200-week moving average. Which I'm making a call, guys. We're going to the 192 period moving average, okay? Because there's 48 business weeks a year times 4, so there's your presidential 4-year cycle. But anyways, that's at I think that's around 12,000 in the Nasdaq, right about here. 11.5 I have to check, and then you have uptrend support from the 09 low in the Nasdaq, right around 10.5. So you have 10.5 to 11 in the Nasdaq, 3,400 support. So even if we do get one more push down, I think as a team, we're debating whether we've seen the lows in June or we're having one more push down. But I think for the 4 of us, do we all believe, and tell me if I'm wrong, that support will be found here or slightly lower? And that was a question.
I mean, from my end, looking all of these correlations that you already mentioned, that's I think it's the most workable, realistic scenario for the time being.
100%.
Even on this inflation thing, my case was for months that inflation is going to go down, and it's going down. And I think this is, however, it's overreaction. I see that they are pricing in already very aggressively, even 1% move in the next meeting of 21st of September. So, I mean, what they expect, that inflation is going down full percentage in 1 month. I mean, that's kind of oblivious to me. So inflation is going down.
I totally agree with you.
Yeah, I mean, so not just at the pace that somebody forecasted. I mean, which is way kind of, in my opinion, out of the line of the kind of a median how it should go down. It's not going to go down by elevator, but as the prices decreased and the data lags, I think it's going to fall further. So I mean, as the markets we know, and we use Elliott wave because emotions get exaggerated, and that brings volatility. For now, the move is looking to the further move lower, and we have to anticipate both of possibilities. Unfortunately, we don't see any signs yet of a sustainable recovery, and I think that the gravity is still towards lower support levels, at least for now.
Yeah, really good points there, Terry. What do you think?
I'm not that much of a short-term trader, so I'm obviously looking for a longer-term development, and my focus right now is to start to look for those stocks that are holding their strength while the rest of the market is weakening, and then developing my watch list for what's going to be the next set of stocks that are going to lead us upward. So again, you guys, I'm all on board with the near-term weakness and move lower. But after that, the bull market in the longer term is going to resume, and I don't want to be caught, sitting out in left field after the market's already moved back up, and then say, what do you want to be in? I think the opportunity is start looking now for, like you said, you mentioned, I think Tesla as one opportunity, but I think there are dozens of opportunities out there. There are stocks that are demonstrating strength in the face of this weakness. So watch for that. That's my focus.
Sounds totally good. Let's jump into it. Todd, you want to take the screen and walk us through the charts?
Sure.
All right.
Let's see. Do I need to fit that? Do I need to take it?
Nope, you're good to go. Passing it your direction. Take it away.
Okay. Yeah, good feedback. And Alex's point is a really, really good one. So this is CPI going back to the 20s. Inflation has been benign with the exception of there's a little push here in 2008, which I found interesting. Inflation got up to about 5%. But with the exception of that, I mean, the last significant move we saw was here in 1978. So we were basically flat for 45-ish years. And then we got the move up post-pandemic. And we have seen it tick down. And then to Alex's point, the core was expected to drop the month over month headline was supposed to drop by 0.1%, and it came in hotter by 0.2. So 0.3 swing month over month, I believe. And then the year over year was a very small margin as well at the headline. So, you've got benign inflation after 50 years. We go from 0 to 9% within 24 months, and the market flips out because we missed expectations by 2 or 0.3 on the month over month and the year over year. So I think you kind of have to take that with a grain of salt. I found yesterday's move very interesting. One quick thing I'll put in front of Ben, and this is more fun. Like I said, I've kind of said I'm going in the closet with LIQUIDITY, but I can never get away from it. It's always that. I'll throw this in front of you. It's not exactly the best count. It doesn't follow the ideal relationship of a triple, a WXY, but this is like PhD level Elliott wave. It's not ideal for reasons that, for the interest of time, I'll table, but it could possibly be WXYX, and then you can go into a triangle in the final Z wave. So A, B, C, D, E, and you could actually say the impulse started on July 25th. We've come back, we tested 786, and that's what we call the retracement of last resort. So that's at like in the NASDAQ 1192 area. We're coming back to retest. Futures now are up just a touch. Bennett, do you hate this? Or what do you think?
I don't hate it at all, Todd. And hold on. One thought that came to mind when you presented that triangle in the Z-wave position was a discussion we had back in Apple where you had identified a Z-wave triangle coming out of...
It was like 2015 or 16.
It was actually 19. It was the summer of 19. But you were absolutely spot on.
Feels like a lot longer than that. Are you sure?
Yep. I'm looking at it right now on the chart.
Yeah, you're right.
So I don't discount this possibility. The only pushback I would have would be the fact that the D wave closed higher than the B wave, but
it's fractional.
But you could just call that an ABC, Todd, with a truncated C wave and an expanded B wave. So the implications are the same. So I can't hate it.
It's like a point or two of a $12,000. No,
it's like $125, but I mean 125 points, but still, you can arrive at a completed Z wave.
I think the futures are not even that. I can't even see that number that far away. So hot. Okay, I mean it's pretty small. But I mean, okay, so I don't want to get hung up on that. So that's the dreaded triple. So WXYX triangle Z. If by chance we double bounce, it would happen at the 786. So we'll take a look. And then you mentioned, a viewer smartly said, take a look at the small caps. Like small caps have been strong. And you got to think that's a function of the dollar because small caps are obviously domestic based. They don't have a lot of international exposure. They don't have to repatriate earnings back in, do a foreign exchange trade, and realize less revenue with the stronger dollar. But I also think it's a sign of risk on when small caps are showing strength, specifically small cap growth. All right, so that's that. I did want to talk about internals quick. I'm gonna spin through a couple different things that I'm seeing. So this is a 60-minute NYSE tick chart. And I like to throw a moving average over it. So that's the amount of upticking stocks versus downticking stocks. Anything over generally 600 to 700 on the plus side, minus 700 to 800 on the downside. That would tell you that there's institutional buy-sell programs. So, hits some dude on Wall Street hits a button and buys all 500 stocks or sells all 500 stocks. That's institutional money going in, and that will pick up with ticks. and I throw a moving average, just a simple 20-period moving average over the ticks to smooth it out. And the thing that you'll notice is, from a moving average point of view, a 20-period moving average, the last 20 trading hours of your 6.5-hour New York Stock Exchange session, we have not eclipsed the low from back here in August of 23rd. And then we made a new low here in August 29th, and we have not yet made a new low in ticks, which indicates, again, institutional selling. We made a new low here in the S&P in purple as the NYSE 20-period tick continues to go up. We're starting to head back down, but you could still say that the moving average is in an uptrend. The other thing that I'll look at from a indicator internal point of view, take a look at advanced decline. Not too much going on here. Strong move up in advanced decline here. Okay, so 20-period moving average of a 60-minute advanced decline made a new high relative to August 25th, where the S&P clearly didn't. We just started to make a pretty good, we had a lot of selling. Everything was down. Breadth was nasty yesterday, no doubt about it. But from a moving average point of view, we still have not yet broken the mid-August low there on the 22nd in terms of advanced decline. I find that interesting that we had so many advancing stocks on this move up. It's the same thing. It kind of echoes the NYSE tick program. And then this is the craziest thing to me, the VIX. I can't believe how quiet the sell-off is. The VIX. I mean, it's crazy how quiet and unvolatile, non-volatile, whatever the word is, this move is. This is the S&P in purple, and here's the VIX. We are nowhere near the 30, 31, 32 level that we saw back here in May and June in the S&P as we're making new lows. We're off the low. The sell-off here, we are starting to push 26, 27, but why are we not in a 30 VIX right now? I find that really, really strange. From there, I just want to show you a couple, getting into the macro that I mentioned. Look at rates. Actually, these are not rates. These are the bond prices themselves. So this is the NASDAQ over the 2-year and 30-year Treasury. Clearly, the bond markets are dropping as interest rates are going up. And that's what's shocking this whole market is interest rates going up on the short end and the long end of the curve. And there's a lot of discussion. Do we have curve inversion with the 2s versus the 10, the 3-month versus the 10? And then Terry, you'll know Tom Lee, who I'm friends with. I have a lot of respect for him. He'll tell you that the nominal yield curve actually doesn't mean anything. It's the real yield curve. With inflation running 8%, it still pays businesses to borrow. If they can borrow at 4 or 5% and inflate it away at 7, 8%, that's a good deal. But bonds are selling off to new lows while the NASDAQ is nowhere near the low. So rates have moved higher, which supposedly are causing the rotation out of growth and the tech stocks and consumer discretionary, as Terry mentioned. But NASDAQ is nowhere near the lows as bonds are. And as a function of that, in the currency market, the higher our rates are in the US, the more international investors are going to sell their domestic securities, stocks, fixed income, whatever it may be, real estate, do an FX trade, sell their local currency, buy the dollar to buy higher yielding instruments in the US. And I think stocks. I still think there's a carry trade going on, which is creating this little bit of shelf of support in the market, not having an automatic free flow, not having a 35, 40 VIX, panic selling. I think there's a quiet bid out there. And it feels like it's been an August summer market that has trickled into the first 2 weeks of September. I think it's still trading like a summer market. Look at the dollar over the NASDAQ. Now, this is an inverse dollar. Okay, so this is basically euro dollar. Okay, this is the chart of the US dollar making new highs. Okay, and again, the dollar is supposed to be crushing the stock market. That's what they are telling us. Well, the dollar's been strong for like 8 years. We were in a bit of a consolidation. The dollar has rallied sharply here, and only now, in the last little bit, has the dollar started to impact the stock market. Okay, maybe. But what I find interesting is if you take this dollar, flip it on its head, same thing with rates. as interest rates, bond yields are moving higher, bond prices are pushing lower, the more attractive our US dollar is. Alex will talk about this. FX markets are going crazy. Dollar yen is ripping to the upside. Dollar is strong, but again, stock markets are not confirming by breaking those June lows with the currency market. So something is odd in here. I'll just take you through real quick here. Consumer discretionary, I love it. Bennett mentioned Tesla. It's the largest holding that I have in the growth portfolio, showing a ton of relative strength. I was on CNBC yesterday, taking them through the technicals, and one stock, Tesla, continues to be it. We go into the fundamentals of that. But specifically, Tesla is, obviously the Mac Daddy of consumer discretionary, and some would say technology. But, you look at what CPI did yesterday. The market freaked out that we missed by 2/3 with an 8% CPI, and they were looking for a downturn. My big takeaway is you look at the Fed fund futures. So right now we're at 2.25 to 2.5 is the range. 2.25, 2.5. Yesterday we were at a 91% chance of going to 3.25. But we took that basically 20-30% and pushed it up to 100 basis points at the September meeting. So fine, we're going either to 3.25, 3.25, 3.5. You go out to November. We were at, so again, it's hard to carry this over. So we're either going to 3, 3.25, 3 or 3.25. Let's look at those two lower bounds, 3 or 3.25. There was a 78% chance a day ago that we were going to 3.5 as the lower band. We dropped 50% to 23. We pushed that 50% to 3.75, which essentially would be a 75 basis point increase in November, and then put a 20% chance of 100 increase in November. And then out to December, here's the granddaddy takeaway. Basically, the terminal Fed funds rate was going to be 4.25. We are now at 4.25, 4.5. We were at 2% a day ago. We picked up 40% chance that we're going to be at 4.25 to 4.5, and then a little 11% chance, 4.5, 4.75. So call it a 50% increase from the day before. That this is the granddaddy takeaway of everything that happened with CPI. The terminal Fed funds rate went from 4 to 4.25, 4.25, 4.5. That's it. I mean, okay. Okay. Does that warrant a 5.5% down move? Is that going to change the future value of earnings? Is that, and then, Charlie Biello, I hope I pronounce it right. I mean, he's awesome. He put this out on Twitter. The market's now pricing Fed fund rate hikes 4.25, 4.5, first quarter next year, then rate cuts in the back half of 23. We're going to 4.25, but then, the back half of 23 and 24 down to 3.4% as inflation is clearly moderating. You look at all the inputs, and if you look at inside the CPI report, and I did a YouTube video yesterday on the wealth management site, New Age, newagewealth.com, and I went through the CPI report. It's like rent, it was utilities, it was insurance, it was car insurance, it was, dine out food was a big one. Food increased, at-home food decreased, but dining out food increased. And, if I look at, Terry mentioned it earlier, the consumer discretionary space is showing a lot of relative strength. So this is a weekly relative rotation benchmark to the S&P, and I've got them sort of grouped up by improving position relative to what's going on in the S&P. Leading right now is hotels. Okay, we're leading on the monthly, but this position on the weekly is very strong. This north-northeast heading, strong momentum move, a lot of velocity. Hotels is strong. Automobiles, strong. You look at this guy, automobiles moved into the leading. So we've got travel and tourism, apparel, gambling, auto parts, footwear, broadline retailers, and there's a lot of auto parts out there that are not broken up in this. A lot of the discretionary industries that involve people going out and doing things and traveling and buying things are very strong right now. So when you look at that and say, okay, the market just sold off because we've got inflation that's out of control. Yet you look at what's actually happening in the market, and consumer discretionary continues to be stronger than energy right now. Energy's picking up some momentum, but consumer discretionary and tech, as I'm sure Terry will talk about, is stronger than energy. And specifically, it's the industries where people are going out doing things. And there's a lot of names that Terry mentioned, besides just Tesla, that are showing strength in here. So it doesn't square up for me what happened yesterday, all for readjustment terminal Fed funds rates of 1/4 point. So that's this kind of stuff, this macro, looking at reading the tape and helping you filter into the technicals, the Elliott wave, the setup, filtering through what wave count might work. That's how you pull it all together and be a trader and investor. Guys, back over to you.
Very good. Much appreciated. Excellent discussion. Markets are open, as you can see. Market open clock disappeared. Indexes are mostly sideways. So what do you guys think? Terry, Alex, any feedback?
Yeah, I'm about to do my little part here. Give me a second here. What happened? I'm trying to figure.
I see your Corvette.
Boy,
yeah,
that's sexy.
I'm not sharing my. Hang on a minute.
No worries, no worries.
There we go. All right, Optima. Yeah, we'll get into my stuff here in a minute. Yeah, I just reiterate most of what Todd is saying there. You got to look for what he was showing you guys. I don't know if you picked up on the nuance, but when we're looking at these rotations, we look at them in different time frames. We got a daily time frame, we got a weekly time frame, we got a monthly time frame. So investors are usually longer term holdings. So you want to think about more monthly time frames. So when we look at a monthly rotation, we're looking at the longer time that a stock is being in an outperforming position relative to the benchmark. We narrow down into the weekly to see what's moving currently. So we'd love to be holding stuff that's in the leading quadrant in the monthlies, but we have to know to know where to bring them into a long-term portfolio. We want to be looking at what's improving and what's coming up next up in the shorter time frames with a trajectory that will push it back over into the lead on the longer term. So that's what Todd was showing you. The consumer discretionary sectors, I know a lot of that stuff is lagging. We know that the market has been pushing down, has been pushing lower. A lot of that stuff is lagging currently, but the direction that it's moving, and you can think of this, it's like momentum, right? So we use those terms, momentum and relative strength, which are the two things that plot there. But really, the momentum is rallying back behind technology and consumer discretionary to bring it back up out of the lagging quadrants, back up into the lead over the next year or so of horizon. So that's what we're tracking when we're looking at that stuff. So.
Like you, Terry, I'm managing longer term money in the wealth management side, but I monitor and watch the markets for clues to adjust, and we're not in and out of the markets, but I'm constantly adjusting. I watch it as if I'm a trader, and at heart I still am a trader, but I think even the longer term investor in portfolio manager, especially in this busy market with all asset classes are moving, you've got to monitor it on that time frame if you're going to do this professionally, or with any degree of skill.
Sounds good. Terry, you got your screen ready to rock? We'll take you guys through Optima and sector rotations. Ready to go?
All right, go ahead.
All right, let's hit it, and we'll be back on the other side to take you through macro with Alex.
Hello, traders and investors. I'm Terry Long at tradinganalysis.com here with your weekly sector focus. Like we said, after the release of significantly higher than expected year-over-year CPI results yesterday, the markets made a sharp reversal to the downside, negating much of last week's gains and putting both the S&P and the NDX back below their 50-day moving average. That's this blue line here. You can see that yesterday's move significantly taking out the gains that we made last week. Let's review last week's sector performance first. Now, in the prior week, following those steep declines that we had here, last week's market price action had decidedly more upbeat, with the S&P rising 3.65% and the NDX rising 4.05%. Last week, all 11 sectors finished the week in the green, although after yesterday's sell-off, you can imagine they're all in the red. But we have consumer discretionary, materials, financials, and healthcare look nearly 4.5% gains in those sectors. There was really it was a big push, a big thrust. Yeah, it's a bounce, and then we reached up here around this 41.21 area there, and we got rejected. So let's fast forward over here to this week, and we'll show you. This is yesterday's Monday and Tuesday's price performance. Excuse me, got an itchy nose. Where we've got the communication sector being the week's worst performer. Monday was actually looking pretty good up until then we got that CPI report came out on Tuesday, and that's what really hammered it. Here's price action this week with this morning's tick. The market opened here about 15 minutes ago. Energy is up 1.12%, being the only sector now back in the green. Everything else down in the red. The communications sector down 5.41%, technology 3.96%, and consumer discretionary down 3.86%. But on that bounce, let's look here at the weekly sector performance relative strength leaderboard. In this leaderboard, we are seeing the utilities sector with some slight rising momentum. The energy sector, Todd mentioned something about it. We've seen it rising vertically in terms of recapturing its momentum, but it is not really recapturing a lot of relative strength at this point. Healthcare and staples, they are losing their relative strength, but they are holding momentum fairly stable. So the momentum on the y-axis, relative strength on the x-axis here. Look up here in the leading quadrant. This is the consumer discretionary sector, which as I animate this back, you can see back, we saw the consumer discretionary turn blue with a rising blue improving trend vector back the week of August 26th. And we noted the vector and its tendencies will continue to thrust in that easterly direction and continue to gain relative strength. And as we have done so over these last several weeks now, with the penetration now into the leading quadrant. So the consumer discretionary group is rising up the list here and is now basically number 2. This table over here ranks these sectors by their relative strength score. Utility is still holding the highest relative strength, but number 2 now is consumer discretionary, followed by energy, staples, industrials, and there's technology and healthcare. And all of these sectors are outperforming the S&P, which is here at the origin. Now, not to be outdone, excuse me, I got an itchy nose again. Not to be outdone, look at what's happening here in the financial sector. We are seeing some rapidly developing gains coming back now in the XLF. So that's very noteworthy. We're also seeing a hook back to the north here in the materials sector, although I don't have that rising blue improving trend vector in the materials. I think inside these sectors, there are certain stocks, in order to make this hook and this turn relative to the S&P, there are stocks inside this group that are making some serious advances right now. The communication sector, it's just kind of happy to stay out here, is the lowest relative strength among all the sectors. It just doesn't have any momentum and relative strength gains apparent right now. Now, one more thing I didn't mention, the industrial sector kind of stealthily gathering some momentum and relative strength, and it has just now pressed itself back up here in the leading quadrant, though I will say it's only moderately higher. It's actually challenging the technology sector here again for its positioning. So there are opportunities in there. I'm going to jump over here to, let's take a look at what's happening since we mentioned so much about the consumer discretionary, let's take a look at the top 30 components that I have in this study here. This is the weekly relative rotation for the stocks in the consumer discretionary that makes up that whole XLY. As I animate this back into August, you can see many of these stocks such as Lowe's, Amazon, General Motors, Ford, Etsy, and there's Tesla already pushed over in the leading quadrant. They had been showing you and demonstrating their outperformance with those rising blue trend vectors. I rotated on up till current time. Now we've seen that Etsy, Ford, General Motors, Tesla, Amazon, Ross, Chipotle, Starbucks, Lowe's, all of these consumer discretionary names have pushed over into the leading quadrant. The other thing about the story here is there are almost no stocks down here in the lagging quadrant anymore, as most of those that had been lagging in the consumer discretionary have already pushed up into the improving quadrant. So I have a good mass of stocks behind it here in the improving that can continue to feed over into the leading quadrant. There are some of our past performer leaders such as Dollar Tree, Dollar General, AutoZone, McDonald's, and Yum Brands that actually are pushing down into the weakening quadrant. Dollar Tree held the lead for a long time, made a lot of gains. It certainly, it looks like it's giving back that leadership position, and the money should be, if you had money in this, it should have more than likely be rolled out and put back into something. Todd mentioned that hotels, Hilton and Marriott, hotels are rising rapidly here. These are two of the big ones that I track, and they are both showing blue, rising, improving weekly price trends. The color here represents the price, the weekly price performance trend. And then, of course, it is in the improving quadrant, and these guys look like they're ready to push back over into the leading quadrant. If you want more of this, guys, come join us as a subscriber. We go through all of these sectors and details in our weekly member webinar. I'll give it back to you now, Bennett.
Thank you, sir. Much appreciated, Terry. Markets are open. We've got about 10 minutes until our member webinar. We'll get Alex set up. He's going to take you through the macro scene.
Sorry, I threw you guys off.
No, not at all. I started it off with going too long, so no worries, man.
Oh, you did. We try to pack a lot in this Wednesday webinar. Whether it's the right move or not, we don't know. But I think there might be breakout live streams in our future, boys.
Yep, absolutely, absolutely. All right, Alex, you ready to rock?
Yeah, let's go.
All right, take it away. We'll see you on the other side.
Hey guys, so let's look what's going on the macro levels. We have been talking a lot about this. I will just scroll out of the charts, just show you some technical levels. The situation in rates that Todd already mentioned very extensively. I have already said that I think it's a very exaggerated move. And as you can see, 21st September, market actually starts to price in 1% move. I think that's utterly nonsensical in my view. I don't know if it's going to happen, but suddenly we are at 34% of chance going full 1% because we missed a very over-exaggerated estimation. So we will see how that will go. Definitely, Fed narrative is still kind of standing strong. But in my opinion, in general, my thesis was looking at the commodity spectrum that this will actually be seen of the inflation lower in the next couple of readings, which is actually happening. We didn't go as estimation, but overall we are lower. So from 9.1 we went to 8.5. Now we are at 8.3. And the next one, I think it's also going to be lower, looking at the lag and the commodity spectrum, what is doing now, especially if you see that in this CPI readings, energy takes a lot of space, and oil markets are pretty significantly down in the last couple of weeks. So rates, as you can see, I still see a very elevated monthly RSI, almost pretty highest from 1981, which is a staggering a kind of a reading and we are at around 70.6, inching lower a little bit. So this is the zone. I expect the rates to continue, actually have a short-term reversal. I will talk in the next couple of streams technically what this can mean in the future. Rates is going slower technically, so what is going to happen afterwards, we'll have to digest. Currently, I don't see after this pullback and actually of a 40-year deflationary cycle, and if we label this as a five-way move, ending here a little bit more higher with a potential reversal, nothing good can come of it, and that kind of agrees with our longer-term charts. We can also have a sideways consolidation in X and a small pop-up, so we will discuss this in the next streams. But in the European front also, the ECB hiked rates. They are currently at 1.25, so they made a 0.75 or 75 basis point move on the upside, which actually pulls us up from our support line. Also the same situation, so we have a longer term chart. This is the 10-year bond, and you can see pretty easily just without any Elliott wave kind of labels, that we have been going up and down, but mostly we have been moving in the downward trajectory, and suddenly we have appearance of still not completed potential five-way move on the upside. If that happens, that will suggest that after a pullback, we might have a year or two more troubles with inflation. So we are still awaiting this intermediary wave 3 to finish, look for a small pullback, and then move up in rates in Europe. Although, as I said, Europe is in a very difficult situation on many fronts. The economical readings are not good because all sorts of troubles because of the Russian-Ukraine conflict. But anyhow, I don't think the propensity of the ECB currently to move rates significantly higher, because the readings are big in inflation. In Europe, the propensity is much smaller than in US from any prospect that you can look, either geopolitically, either in a sense of commodities, because the European lacks energy and US does not. Also from commodity spectrums in a soft commodities. So there is also many other things. So I don't think their propensity is large. But anyhow, we are seeing development of a potential five-way move, which will have a greater implication later. But let's go one wave at a time. So if we look also the dollar index, I completely agree with Bennett. I think we are very close to a terminal phase. My Fib cluster levels, which I got from a projection and extension, so a couple of Fib ratios that actually gives us a cluster for the upside target. And also, as you can see, I tend to look these RSIs on the very high time frames, because I think they're reliable. They're actually signaling that the trend is in its terminal stage, and that is backed up with a potential wave count and the Fib clustering targets, which goes from 112 to 114. So I think we are in the last phase, as Bennett explained, of the dollar index run, which you can also connect with the rates, because currently, if you look what the Bank of Japan is doing, and I mentioned that a couple of times, they are having a yield curve control, capping real rates to go up at 0.25. So obviously, the carry trade and interest rate differential from Japanese yen to US is very obvious thing. We have been, Todd and I are in the currency market for a long time. We have been witnessing that many times, a chase for interest rate differential. So I think we're going to see nasty reversal in that one pretty soon. And that I think also dollar yen is coming into a terminal phase of this bull run on the upside. We will see afterwards. So all of this is signaling me to be very cautious in the dollar terms on the upside, and I think we are very close to a potential reversal, either bigger or smaller as we go along. So that is on the dollar index. So if we look Thomson Reuters index, it's pretty much going our way. we identified clearly a 5-way move in around here, I think, in the previous couple of months. And we looked for a couple of targets and then 5-way move downs and a small correction. Sometimes these corrections can go sideways or in a triangle, but definitely I do see still as the dollar might continue higher and we might see these commodities go down lower a little bit more, although the dollar commodity correlation was very imperfect. We have seen for a number of months dollar and commodities go up together, and that's a kind of a very rare mix when you have the supply bottlenecks and all of this, what is pushing inflation and commodities up, and the dollar on the other rate in the interest rate differential. So that mix is rarely seen. But we have seen it in the last couple of weeks. They start to correlate even a little bit more better in a sense of an inverse correlation, because traditionally commodities and dollar has an inverse correlation. So that was a rare mix of circumstances to see on markets. I actually didn't see it for quite a long time. So I still do think that commodities will go down. As this chart suggests, for a potential C wave or a WXY, we cannot see that now. But most of the commodities in a soft spectrum and also in energy, except gas in Europe, of course, I do see oil going lower. That will pair up nicely with the Bennett's wave count and expecting markets to go a bit lower. My support levels are between 75 and 80 on the Brent crude. I don't think this is the failed fifth. This is the very long-term chart I've been showing a couple of times. I do think we are in the terminal phase, and that also goes well with a general push in the at least Western world to go electric. Is that viable or not? How fast it's going to happen, we can discuss. But definitely new alternative sources of energy are very much in play. So I do see this going up in the next cycle on the upside, which pairs up with my couple of relatively bullish inflationary cycle, but this is years in advance. So I will pay and explain much more closely this what I see in charts and potential move up. So we can identify 5 waves up from these lows. We disregard, of course, the 2020 May futures move to the downside. So I do think we're going to continue higher after this pullback. So one more thing with this gold-silver ratio, I will show you quickly gold and silver. So it's backing off now. Silver is moving pretty nicely on the upside from close range of our levels. And we are seeing a potential 5-wave move down actually forming in this gold-silver ratio, which I've been calling for some time. And I have a strong case that silver in the next cycle will go and be favored in a sense of moving up than gold, which actually this chart explains. So let's look gold and silver quickly. So gold still didn't give up an invalidation level. We are still hovering around that. So we're going to keep this wave count until we have clearly this fit floor invalidation levels and also this wave 4 invalidation levels. So there is alternative wave counts, but they don't pair much to the lower levels. We can see if we break these levels just a touch lower prices, but overall I do see gold going higher in this fifth wave on the upside, and that's for now. It's still very much in play because this is a pretty sideways consolidation that we are seeing. And silver, we are seeing a nice push on the upside. So we still don't have a clarification on the 5-wave move and a kind of a confirmation of this strength, but we need to see more of this. As I said, always when you see these moves on the upside, you should look at the previous swing highs, which will actually tell you is this sustainable or not. So higher the swing highs, previous swing highs are reached, and especially in 5-wave move, that will give you the case that on a pullback you can you can have a very small risk of attempting for a potential move up in silver, which I think potentially now we will see. So next week I will give you an update on that, or tomorrow on a Crypto Lab with Alex, where we also go over a macro space. I will just add that Ethereum chart and a couple other cryptos do confirm that now, as many of guys in a big hedge funds are saying, that crypto is macro. That's a kind of a new narrative. So in my opinion, Ethereum still look bullish, and I have a very nice for you chart to explain that. But I do agree with Todd. It's pairing very well with the outlook that we are very close to lows and that we're gonna go up. So that's from me, guys. Back to you.
Very good. Much appreciated, Alex. Members, we'll see you in just a couple of minutes for our weekly member webinar. If you all enjoyed the content, please subscribe with notifications. Drop a comment, drop a like. It doesn't cost you anything. It's a great way to support the Trading Analysis team. And of course, you can check us out anytime, tradinganalysis.com. We would love to have you test drive our services. And of course, tomorrow morning, 9 a.m. Eastern, with Alex for Crypto Lab. Gentlemen, solid show.
Guys, before we go, definitely click that thumbs up, please. That's the one favor we ask you if you're not members at Trading Analysis. Just let YouTube know that you enjoy the content. So please, everyone, click that thumbs up on YouTube. Appreciate that.
Sounds good. You guys have a good one. We'll be back same time, same place next week. See you then. Take care.